Hello, this is Mijune from Michu University. Yesterday on the broadcast, I mentioned that I wouldn't be able to deliver Mijune's today's Michu news on July 3rd and July 4th. So some of you might be surprised to see a video uploaded today. Today, I've prepared a slightly special piece of content. I've been promoting the Mijune membership really hard lately, as you know. But at the same time, I felt a bit sorry in my heart. There are so many people who have passionately supported the Mijune YouTube channel so far, and among them, there are also people who, for various reasons, can't join the Mijune membership. So I was a bit worried that these people might feel left out, especially today, since I'm preparing a special live broadcast exclusively for the members. I couldn't feel at ease about it, so I started thinking about how I could make these people feel better. Back in May, I also did a live broadcast with the Mijune members, and although this is a rebroadcast, by making it available now, I wanted to show my care for those who might feel disappointed that there are no Mijune broadcasts today or tomorrow. I covered some general topics related to investing in United States stocks that aren't time sensitive. So even though this video is from a month and a half ago, I believe you'll still find it very helpful if you watch it now. Everyone, as you watch this broadcast, I hope you can relax and feel at ease. Starting next week, I'll make sure to provide broadcasts that even those who aren't members can watch comfortably. All right, now let's watch the rebroadcast of the special Mijune show prepared for July 3rd. It's a rebroadcast of the live show that was originally aired for members in May 2025. Let's watch it again together. We'll start right away. Yes, it looks like the broadcast is working properly now. Many people are greeting us. Every time I do a live broadcast, I always feel a bit nervous and it seems a bit challenging. I hope things go smoothly today, since there aren't any technical issues. Last month, we had a lot of problems, like a lot of buffering. So today, I want to change the format a bit. As for me, Naru, the reason my voice is hoarse is I just uploaded Mijune's broadcast a moment ago, and I use my voice a lot when doing Mijune's broadcast. So my voice is bound to get a little hoarse. My energy level is also pretty low right now, so if I talk too loudly, I won't be able to do a long live broadcast. That's why I'm thinking of saving my energy and taking it slow today. That's why I'm doing this live only for the members. When I do a public live, I end up worrying about too many things. And I worry a lot about making mistakes here and there. But when I do a live just for the members like this, I feel a bit more comfortable. Even if I make mistakes, I feel like you'll understand. And just doing a casual broadcast like this feels meaningful just because I get to meet you all. I'll try to relax and continue. I think everything will go smoothly today without any interruptions. May. So I guess everyone who was going to join has joined, right? It's about 1:03 now. All right, then let's officially get started. Hello, I'm Mijune from University with United States Stocks. I am personally very happy to have this cozy meeting with all the Mijune all-in-one members again this month. A lot has changed since last month's live broadcast, hasn't it? If I remember correctly, last month's broadcast was on April 14th, and since then, the United States stock market has surged about 10%. So last month, we talked about how the market was tough, how we should endure it, and whether a rebound was possible. Today, I think we can be a bit more relaxed and have a more casual conversation during our live broadcast. And what did we feel over the past month? The problem is that theory and reality keep clashing. We know it in our heads. So, as I've repeatedly said, it's important not to leave the United States stock market. Even though I say this, When a downturn comes, many people pack up and leave. But this time, we shouldn't have packed up and left either. It seemed like it would keep falling endlessly, but the stock price, which had dropped nearly 20%, actually soared more than 18% in just 5 weeks. So, when investing in stocks, it's really important to know how to control your emotions. I think it was a good opportunity for us to study again and to train and educate myself once more. This month, I changed the way we do things a bit. Last month, since I gave a rather stiff presentation, the preparation process was a bit tough for me as well. And since I had to run several pieces of software during the broadcast, I had to use a system called Open Broadcaster software because that's the only way I can share my desktop with you all. Since I was running so many programs at once, I think my computer exceeded its capacity. That's why there was a lot of buffering and the video kept freezing in the middle. So today, to make it a bit different from the usual Mijune broadcast, I'm displaying the full screen like this. I'll try to proceed in a format where you and I are just sitting face to face and having a conversation. Mijune Live was planned for you all anyway. Since it was created for our precious members, if you later say you prefer the old way or want a presentation, I'll prepare a presentation again. I'll keep improving and adjusting things the way you want so I can show you how we keep evolving. I usually do the live sessions based on the questions you leave, and today I've gathered questions from 10 of you as well. If I select about 10 people every month like this and answer your questions, eventually, after a few years, I think I'll be able to answer all the questions you've left. I'm hoping that at least once I'll be able to answer the questions each member has left. First of all, there are a lot of fun and useful questions today as well. Let's briefly go over the current market situation first. The current issue is the United States credit rating. The credit rating has now been downgraded by Moody's, one of the world's top 3 credit rating agencies. So it caused a shock to the market earlier this week. It could be a shock psychologically for investors. However, if we look at past cases, these kinds of credit rating downgrades have not actually led to rising interest rates, economic recessions, or stock market declines. So, of course, it was news that could be psychologically burdensome, but just because the credit rating has dropped, there's no need to give up on United States stocks. My personal judgment is that this isn't such a big event, and although I say it's a personal judgment, I always make my decisions based on the numbers anyway. What I refer to the most is past history. So if you look at the history of the United States stock market, there were very few cases where stock prices plummeted just because the credit rating was downgraded. That's what I want to say first. In conclusion, from an investor's perspective, I think that at times like this, we should pay even more attention to company performance. Of course, there are concerns about earnings outlook due to the Trump tariffs. People are worried that the impact of tariffs will cause companies' earnings to decline in the future. There are a lot of concerns that margins could be squeezed and sales could also decrease. But actually, the recent situation is improving because last week there was a settlement in the trade negotiations with China. So for now, companies' guidance hasn't been significantly revised downward. Stock prices are earnings multiplied by multiples. While the current market multiples aren't exactly low, as long as companies' guidance and earnings don't drop, I personally believe there's no major reason for stock prices to fall significantly from where they are now. Nevertheless, it's certain that tariffs are rising compared to the past. These are things that didn't exist before or were at very low levels, and now they're going up a bit. So we have to acknowledge that tariffs are a reality compared to before. We can't ignore this. So personally, I'm not sure if you've already watched Mijune's YouTube broadcast today. A company with a strong moat. Having a strong moat ultimately means having pricing power. When prices go up, I don't get to keep the increase from the higher prices. We're talking about companies that pass those costs on to consumers or their clients. So I think it's a bit safer to selectively invest in companies that can freely raise their prices. And in addition, there's one more thing I'd like to emphasize. The future is not set, as I always say. The future of companies is not set. The future of the market is not set, and our personal future is not set either. If our future were already set, there would be no need to work hard, since our fate would already be decided anyway. But we all know that's not the case. If we work hard, we can change our future. So the future isn't something to predict, but something to create. So just as our personal future can be created, a company's future can also be created. So it's important to keep an eye on news reports, announced economic indicators, and companies' performances going forward. And based on those results and movements, I hope you become wise investors who can respond flexibly. That's all for the market situation summary. Today, it seems there aren't any big news, major concerns, or issues. So the market is relatively calm. Even if you look at something like the fear and greed index, it's currently in the greed phase. So I don't think it's a market situation that causes a lot of concern. Recently, the stock price has gone up for 6 consecutive days. So as it keeps rising like this, there will be days when it goes down. And today, the stock price could also fall. But personally, I don't think the market is at a stage where we need to worry that much. All right, then I'll go ahead and answer the questions you left for me this month one by one. I've picked out the questions like this, so let me start by reading the first one. Hello, I'm Jorin, a newlywed wife living in Yeongdungpo. First of all, my husband is such a huge fan of Misho that he even signed up for the membership. Thank you for always being the driving force behind our store's finances. We both share a love for United States stocks, but actually I'm more conservative while my husband is more aggressive. Sometimes we often have debates about investments. Regarding this, I'd like to hear your advice, Miju, and also whether you and your spouse manage your assets separately and how you do it. I'm a huge fan. You've left such a sweet message like this. My wife and I manage our assets together. Of course, we each have bank accounts in our own names, but we can still freely access each other's accounts through the banking app. So my wife sometimes logs into my account, and I also log into her account to transfer money and things like that. So even though we have accounts in our own names, you could say that it doesn't really have any special meaning. Since we're on this topic, let me share something about my personal life, not just what you mentioned. I believe that the decision to get married is only valid if living together as a team is more advantageous than being alone. If being alone is more beneficial, then there's no need to get married. So, among those who are participating in this broadcast, if any of you are married, it's because getting married was more advantageous for you. No one sacrifices themselves to get married, right? So 1 plus 1 isn't just 2. When two people with different strengths and weaknesses come together, they create synergy. So 1 plus 1 can become 3 or even 4. And that's why I think we meet and live with people we didn't know before. So, in my personal, very personal opinion, if you manage your assets and investments separately while being married and live your own lives, then 1 plus 1 will only ever be 2 at best. So that's a loss. That's why, in my personal opinion, living like that isn't really desirable. Of course, there are probably many people who think differently from me. The same goes for stock investing. When two people with different personalities meet, there are bound to be disagreements, right? The person who just asked the question said she is conservative and her husband is aggressive. When personalities are different like this, that's how disagreements and debates happen. And then you'll compromise, right? As you go through that process of compromise, I think the chances of making a better decision increase compared to making a decision alone. One of my favorite words is probability. Stock investing is a game of probability, and you have to increase your odds. to do that, I think there needs to be debate and opposing opinions. When I used to be a hotel general manager, hotels have various departments. There's the operations department and the sales department. Those two always argue. That's because the sales team makes a lot of promises. If you reserve at our hotel, we'll provide you with various services and amenities. So in order to bring in big groups and get group bookings, they accept even really difficult requests. Then there are the hotel operations, right? There's the front office, housekeeping, and then the food and beverage department as well. Then the department heads get really angry about this, saying, how can you promise all this on? So they get really upset. I think it's actually very healthy for these kinds of conflicts to arise. So as a general manager, my role was not to take sides here. Since both sides have different positions, I thought the general manager's role was to mediate and help them reach a proper compromise. Because everyone has different roles and perspectives, I believe that meeting, compromising, and working together would create a healthy organization. So from my perspective, I think investments should be made in the same way. For your information, my wife is more conservative than I am. She's from Daegu and I'm from Seoul. My wife is very conservative. And I'm aggressive, but my wife is different from me in that she's very curious. I'm the type who's very cautious and worries a lot, but my wife is not like that. She's curious. So, for example, when it came to Bitcoin, I was very cautious about it, but she became interested in it much earlier than I did. She kept asking me to invest in Bitcoin. I was against it. Then, thanks to my wife, I was able to start investing in Bitcoin last year, and until recently, I've been making very good profits. So, the two people who asked this question are also newlyweds, right? That's why I think it's only natural that you have even more differences of opinion than we do. So, like us, my wife and I have been living together for over 20 years. We've been married for 21 years now, and as you live together for more than 20 years, you start to resemble each other. And as you keep making concessions, there aren't as many conflicts of opinion. So, as those conflicts decrease, the synergy also tends to decrease a bit. So, I think that during the early days of marriage, when there are still a lot of differences between each other, there's also a lot you can learn from one another. I'm not sure if I answered your question well. Let me move on to the second question. I received this question recently and I found it a bit puzzling, but I'll read it out. There's an opinion that InnoData's competitiveness is uncertain and that it's overvalued as an artificial intelligence themed stock. I understand you've held a significant amount of InnoData shares for quite a while, so I'm curious why you haven't sold them yet. That's the question. First of all, as of May 12th, I had a little over 500 shares of InnoData, but I have sold all of them. And as I always do, I make a post whenever I buy or sell stocks. I shared this in real time with the Mijune members, but it seems you might have missed that post. The reason I sold InnoData at that time, it was because of the earnings guidance. I think I briefly mentioned this on the broadcast, but at that time, the first quarter sales growth rate was over 120%. So even though they grew by 120% in the first quarter, the guidance for the entire year of 2025 was that sales would grow by about 40%. That was the guidance they provided. So if they grew by 120% in the first quarter, but only 40% for the whole year, that means sales growth in the second, third, and fourth quarters would be very sluggish. So rather than saying InnoData is overvalued, I think there are just so many undervalued stocks among the recent artificial intelligence beneficiaries. For example, Advanced Micro Devices, which recently became one of my top picks, is like that. And NVIDIA is still very undervalued as well. And so is Taiwan Semiconductor Manufacturing Company. Many artificial intelligence beneficiary stocks are currently undervalued. So I wondered if we really need to hold a stock like InnoData, especially when reports are predicting its growth rate will decline. That's why I boldly decided to strategically sell InnoData this time. I think it would be good for you to keep that in mind. The broadcast is working fine right now, right? I can't check it myself, so I'm a bit... I hope you can hear my voice clearly, and I'll trust that the broadcast is still going well. All right, then let's move on to the third question. The third one is Amazon. They say things have gotten a bit better because of the tariff agreement, but there are still some new tariffs that didn't exist before. Amazon's cloud growth rate is also being chased by Microsoft, and since you have a lot of it in your portfolio, I'm curious about what you think going forward. You asked about Amazon, and that's right. In my opinion, Amazon is, if you compare it to before the Trump administration, as I mentioned earlier, there's still no possibility that tariffs will be completely eliminated. So Amazon is one of the companies having difficulties because of tariffs. And when I looked at the last earnings results, even in the cloud sector, it's falling behind Microsoft's Azure in terms of growth rate. So even though they're both in the cloud business, Azure's growth rate is much better. However, it's also true that this situation is already partially reflected in Amazon's stock price. How can we know this? If you look at Amazon's stock chart over the past 4 years, it has barely gone up. Over 4 years, it went up about 15%, but during the same period, Amazon's revenue increased by nearly 40%. Net profit has doubled. So earlier, I said that stock price is performance times multiple, right? In this case, performance usually refers to net profit. Since net profit has doubled, it makes sense for the stock price to double as well. But the stock price only went up by 15%. What that means is the multiple dropped. So even though performance went up, the multiple dropped, and that's why Amazon's stock price barely changed. As a result, Amazon's forward price earnings ratio is currently around 33 times. You might say, isn't 33 times high? But over the past 10 years, Amazon's median price earnings ratio has been about 90 times. So originally you had to pay 90 times earnings to buy a company like this, which is because Amazon's innovative side was highlighted a lot in the past. Still, the fact is that the valuation has dropped a lot, since you can now buy a stock that used to require 90 times earnings for just 30 or 33 times. Of course, the reason for this result is that the market now expects that Amazon won't be able to grow as much as it did in the past. But if you agree with the market's opinion, then you would pass on Amazon stock. The reason I'm still holding on to Amazon is because I wonder if that's really true. If Amazon's growth is really over, for example, online retail, what we call e-commerce, it's still hard to say that e-commerce has reached its peak growth. There are still a lot of people who don't use online services. I don't know how often you all use only online, but if you go grocery shopping at supermarkets these days, even if you go to Emart, you see that many people still shop in person instead of using online services. Only when all those people switch to online shopping will online retail reach its peak and come to an end. So I think there are still opportunities for growth left. Secondly, it's true that the growth rate of cloud services is also declining. However, it's still the number one company in the world. Amazon is number one in cloud services, right? Amazon Web Services. So I think we still need to acknowledge that it's the leading company in this area. And now there are some expectations for Alexa in the field of artificial intelligence. I actually have an Alexa in every room at home, but Alexa is kind of not so smart artificial intelligence. So there are a lot of times when it can't answer questions properly. The latest version has come out in my house, but that's how it was before. So in reality, how do people usually use it? They say things like, Alexa, remind me in 5 minutes. But now, with the recent advancements in large language models, true artificial intelligence is finally being integrated into Alexa. This means we're entering an era where we can actually have conversations with Alexa. In the case of Alexa, its performance was much better compared to Apple's Siri or Google's Assistant. So don't you think they might be able to maintain this trend? So when the era of really talking to artificial intelligence at home begins in earnest, there's still this expectation that Alexa might take first place. On top of that, if revenue can be generated from autonomous driving services like Zoox, it would add a new source of income. And there's one main reason why I'm still holding on to Amazon stock. It's because the era of digital advertising is really taking off. When I explained about the trade desk before, I talked a bit about digital advertising. In the past, advertising was all about mass communication. That means when we were watching television or listening to the radio, all viewers used to see the same ads. But that's changed now. Now, with the advent of the digital advertising era, depending on the preferences and consumption patterns of the person currently watching, we all end up seeing different ads. But the reason why this is important is because of this. In my opinion, in the future, the process of purchasing things will likely become very spontaneous and simplified. I think I need to tell you a bit of a story about this. You watch smart TVs a lot at home, right? And we all use smart TVs and smartphones. We'll likely be wearing smart glasses soon. And when autonomous driving becomes more common, you won't need to drive yourself, right? So it's very likely that not only the driver, but also the passengers will be watching a screen together. So now people will enjoy entertainment inside the car. Whether it's watching movies, dramas, or entertainment shows, the era of consuming content inside the car is finally beginning. And when that happens, there will be a huge amount of ads attached to this content. Like I mentioned earlier, advertising can be gamified. So when we use smart devices or autonomous vehicles like this, there will be a huge number of ads that we might like appearing. But when you see an ad like this and find something you like, right now you just think, oh, I like that. And that's it. But from now on, if you like something, you should immediately say it. Say it to your artificial intelligence. For example, if it's Alexa, while watching it, you'd say, Alexa, order that for me. Then the payment is made right away, and that's it. So when the time comes where you can ask to order something you see right now, I think it won't take more than a few years for that era to arrive. At most, within 2 or 3 years, we'll be in an era where you can say, I want to order that while watching an ad. Then the question is, who will handle that order? In my view, Amazon will likely lead in artificial intelligence powered instant ordering, as few other platforms can match its capabilities in this area. There are inventory issues, and there are just too many items that aren't available. So, since there are many e commerce sites that only carry certain items, if we want to order exactly what we want after seeing an ad, this is what we need. Amazon, which purchases all items and has reliable inventory levels, is highly likely to become the main player in the smart era. So, in the near future, whether we're watching Netflix, YouTube, even TikTok, or browsing Instagram, if we see something we like, there will come a time when we can order it with just a word. When this era arrives, Amazon is highly likely to experience a second heyday. With this expectation, I am still holding on to Amazon stocks. I think it would be good for you to keep that in mind. Now, let's move on to the fourth question. At the last correction, I couldn't time my sell orders and didn't secure enough cash in advance, so I personally experienced extreme fear. Currently, I'm keeping about 20% of my portfolio in cash and enjoying the bull market, but I'm wondering when I should increase my cash holdings. You asked a question about cash allocation. You said it's suddenly cutting out a bit. Oh, Wanim, is the broadcast cutting out right now? I hope it doesn't cut out today. Is it coming through well? Yes, got it. You're confirming that it's coming through well. It keeps cutting out from time to time, though. It's really difficult. When I go to Malaysia later, I'll try to get a faster internet connection. Even though I'm using the fastest internet in the United Kingdom right now, there are still these issues. It's a bit challenging. All right, this time I think I need to give you an answer to the fourth question that I just read earlier. Hold on a second. Why is this cutting out like this? Yes, that's good. When I lower the video quality from auto, it doesn't lag. So if you adjust the video quality a little lower, it might help. Thank you. The appropriate cash ratio varies for each investor. I've mentioned this a lot, right? But I've often used 20% as an example, both on broadcasts and in the past. So as a result, some of the non-supporting members and subscribers think that the cash ratio should be 20%. That's just my standard because as an investor, if I hold about 20% in cash, for example, my investment fund is about 1 billion won. Then out of 1 billion won, I have about 800 million won in stocks and about 200 million won in cash. At that time, this is how I feel. Even if the market goes down, I don't feel any particular psychological stress. And even if stocks suddenly go up, I don't feel like it's a waste or that I'm missing out. So I figured that 20% is appropriate for me. I realized this after adjusting and readjusting my allocation. So since everyone has a different personality, it really depends on the person. Some people feel comfortable with just 10% in cash, while others need 40% or even 50% in cash to feel at ease. If I were in my 70s, I would probably feel the same way. If I were to suffer losses in stock investments at that age, it wouldn't be good. So I think I would also want to keep about 50% in cash. So since I'm still in my early 50s, I feel that even having just 20% in cash can give me some comfort and peace of mind. So once you've found the right cash ratio that suits you, the next step is to look at various indicators. For example, the fear index, Cho Isak's market score, which has been quite accurate lately, and cable news network's fear and greed index. It's a good idea to refer to these kinds of indices and adjust your allocation little by little, increasing or decreasing as needed. For example, what about someone who usually has a 20% cash allocation? If the market has entered a complete greed phase, that means market indicators like the volatility index are either soaring or dropping dramatically. The volatility index drops significantly, and the fear and greed index is fully in the greed zone. And now even the market score from Choice Tagi shows extreme greed. In this case, you can start selling off in portions and increase your cash holdings to 30% or even up to 40%. And if the downward trend continues like in early April and we move into the fear stage, and then the volatility index shoots up to 50, goes over 40, if that happens, you need to be able to do dollar cost averaging and go all in with most of your cash into stocks, a flexible investor in a way. In my opinion, there's a high chance you can make good returns. I hope that answers your question. Next is the fifth question. I've been appreciating the valuable analysis and insights you share in the membership. Thank you for your efforts in sharing good information every day. Miju, when do you consider it a golden cross among the movements of the 50-day, 20-day, 60-day, and 120-day moving averages for individual stocks you are watching closely? And Miju, when you judge the buying timing of individual stocks, if the company's fundamentals are strong and the macroeconomy is also favorable, I'm curious how much you rely on the golden cross in technical analysis. You asked a question about technical analysis. I used to talk about this often in the past, but it seems I haven't mentioned it much lately. The two most important things when selecting an investment are the company's growth story and its fundamentals. So when choosing a company, there's no need to look at momentum. You can think of it as selecting companies based on these two factors and building your portfolio accordingly. Here, the growth story refers to something more long-term. So you look at how big the potential market is, how low the market penetration rate is in that industry, how high the company's market share is, and finally, how strong the economic moat is. For example, I have Tesla as my top pick in my portfolio. And the reason I have Tesla is, first of all, the potential market size is enormous because both the autonomous driving market and the electric vehicle market are going to be huge in the future. And as I mentioned, the market penetration rate in those industries should be low, and it is indeed low, because there are still far more people driving traditional internal combustion engine cars than electric cars, and there are almost no people driving autonomous vehicles yet. The penetration rate remains very low, and this company's market share needs to be high. Tesla still has a decent market share, of course. Even though many competitors have appeared, its market share is still relatively high. And does it have an economic moat? I think it does, because the amount of data is enormous. Autonomous driving ultimately relies on artificial intelligence decisions based on data. So the more data there is, the better the artificial intelligence can make accurate decisions. Therefore, Tesla is in the most advantageous position when it comes to autonomous driving. Tesla's clear growth story enables it to pass the test, which is the case for companies with solid growth narratives. Next, we have the fundamentals, which are more short-term in nature. Since this keeps changing continuously, you have to keep watching it. For example, things like earnings results, growth rate, profitability, and earnings guidance. These are what I'm talking about. So if we judge that a company's fundamentals are really good, that it's a strong stock, then we can include that company in our portfolio. If any of you find it difficult to measure fundamentals yourself, you can examine various indicators. On ChoiceStar, you can check the fair stock price for that particular stock, and there's also the SMART score. That SMART score represents the fundamentals of the company. So it would be good to check how high the SMART score is and what top percentage it falls into when making your judgment. Now, once we've added this company to our portfolio based on these two factors, growth story and fundamentals, it's not like we only have one or two stocks in our portfolio. In my case, I have 18 stocks. So I need to manage my portfolio with these 18 stocks. And what you need at this point is momentum. So with momentum, you buy more of the stocks that have strong momentum, reduce the weight of those with weaker momentum. And if the momentum gets really bad, whether it's due to a major negative event or a fundamental issue causing the momentum to completely drop, you might even have to kick it out of your portfolio. For example, Supermicrocomputer, you all remember, right? It brought us a lot of profit. In my case, I made over 300% profit with Supermicrocomputer. Even though it's such a good company, later on, there was a problem with its fundamentals. At that time, an accounting fraud issue came up and the momentum got really bad, so that's why we excluded it from the portfolio. In this way, you can see that momentum can play a role in determining the investment weight for this stock. But there's a problem. There are just so many different momentum indicators. Personally, I only trade using the golden cross. You end up trading too often, so there's a higher chance of making mistakes. And you also have to pay a lot in fees. So I think it only makes sense if at least two golden crosses happen in a row. That means when the 5-day moving average crosses above the 20-day moving average and also crosses above the 60-day moving average, when both of these upward breakouts happen, that's when I think it's necessary to increase your position. In conclusion, I want to say that technical analysis is not about selecting which stocks to invest in. Instead, technical analysis is used to adjust the investment ratio of each stock in your portfolio. I'm not sure if that answered your question. You mentioned that Ira's Name's broadcast had already started and you joined in a hurry, but we'll send you the link to this recorded broadcast later through banding. You can just watch it again from the beginning at that time. There's no need to worry. It's time to read the 6th question. On the show, you said that when the fear and greed index enters the greed zone, it's better to reduce your stock holdings. Which stocks should I reduce? For example, what about stocks that have the highest returns but still have a lot of upside potential? Or should I realize some profits? Or should I sell all the stocks with low returns, or even those in the negative and those with declining momentum? Mijune, I would appreciate your wise answer. This is the question that was asked. Now, once again, I'd like to say something very important. The first thing we absolutely need to remember is this. An investor's rate of return doesn't matter at all. Not just the investor's return, but also the year-to-date return, the 1-year return, or the 1-month return. In fact, while this might help measure momentum, it has absolutely nothing, or 0.01%, to do with the company's value. So my rate of return doesn't show the investment value of the company. It just shows how much I paid for the stock. You need to remember this. For example, someone who bought NVIDIA 5 years ago has a return of over 1,300%. United States stocks are frequently mentioned in comments. Some say they bought NVIDIA in 2020 with a 1,100% return, while those who bought it 5 years ago have a 1,300% return. However, those who bought Nvidia 6 months ago are currently seeing a return of around minus 9%. The stock price has increased 14 times over 5 years, making it a good time for the early investor to sell. However, the recent buyer has a negative return, presenting a buying opportunity to average down at the lower price. The same stock can be seen as overpriced by one person and cheap by another at the same time. This seems contradictory, doesn't it? So my return has nothing to do with the company. When I buy stocks, there's really no need to look at my own return like this. I've mentioned several times before that it's really not a good idea to look at your returns when checking your stock portfolio. Honestly, I've never looked at my returns. So one thing you can check is that when you go into your portfolio, you can see the total size of your assets. So for example, if you invested 100 million once, sometimes when you check, it might have dropped to 80 million. Sometimes it goes up to 90 million. And on some days, it even goes up to 120 million. Now, what's important is that your total investment amount increases like this. How much profit each company is making for me right now really doesn't matter at all. I'd like to say this once again. So along with that, there's something else I'd like to mention. If we don't sell the stocks we had until yesterday and keep holding them today, most people do that, right? They don't sell that easily. So if you had them yesterday, you still have them today. But what about this? It's correct to understand it as making another bet on the same stock when the market opens today. I was thinking about how I could explain this to make it easier for you, and I found a good example. Let's say we go to the racetrack and we place bets there every day. But it's like betting again today on the same horse you bet on yesterday. For example, yesterday I bet on a horse named A, and that horse A came in first place yesterday. So I must have made a really good profit. But I go again today, and just because the horse that came in first yesterday won, it doesn't make sense to say it'll come in last today. Yesterday and today have nothing to do with each other. So what about when you go to the racetrack today? It's not important who came in first yesterday. What's important now is which horse is in the best condition at this moment, which jockey is in the best shape, which horse has no issues, and which horse looks a bit off. You have to look at these things to determine today's winning chances. That's how stocks are. So it's not the returns up until yesterday that matter. What's important is that when the market opens today, you should be holding the best stocks and you shouldn't be holding the worst ones. So holding on to the stocks you had until yesterday and not selling them today means you're betting on the same stocks again. But usually if the stocks you had yesterday performed well, there's a high chance they'll do well today too. Because it's the same at the racetrack. If a horse won yesterday, there's a high chance it'll win today too, because there was a good reason for it to win. So stocks that went up yesterday are likely to go up again today because the stock price is going up due to a lot of good things happening and strong fundamentals. I think it would be good to interpret it that way. And now, regarding your question about what to do during the greed phase, if you want to reduce your cash ratio during the greed phase, if it were me, I would sell stocks like these. The very first thing is to sell stocks with weakened momentum. The reason for selling stocks with weakened momentum is that negative catalysts are already being reflected in the stock price. We can't possibly see all the news in the world. I spend about 13 hours a day on stocks. During those 13 hours, I search through various news channels to keep up with the news, but there are still some news stories that I miss. Sometimes I see them late. So for stocks with weakened momentum, all the negative catalysts in the world are already reflected in the stock price like this. So when momentum weakens, you can understand it as the company having some problems. Now, the second one is stocks with excessively high valuations. It's crucial to understand that when I say the valuation has risen excessively, it doesn't necessarily mean my returns or the stock price have increased. It specifically means the valuation itself has gone up. When the valuation increases, for example, I'm talking about things like the price earnings to growth ratio. Even if the stock price has gone up by 100% or even 200% like NVIDIA, if the price earnings to growth ratio stays below 10, it's not a stock with an excessively high valuation. Just because the stock price goes up doesn't mean the valuation goes up. And even if the stock price drops, if the earnings drop even more, the valuation actually goes up. So after excluding stocks with weakened momentum like this, I would recommend reducing stocks with excessively high valuations in your portfolio. All right, let's move on to the seventh question. The question is quite long. Recent situations have made me realize the importance of cash allocation that Miju has always emphasized. So, starting this month, I'm wondering if I should stop buying stocks for a while after getting my paycheck and instead buy gold or bonds, or just leave the money in a parking account. Or, since the market is starting to rise now, should I put in more money? I'm debating what to do. Also, these days, there's talk about a tariff attack. What is that? I had almost recovered my returns before the tariffs attacked. I'm thinking I should sell some to increase my cash holdings, but they're all good stocks and I don't see anything likely to drop. So it's really difficult. I'd appreciate your advice on what you would do if you were in my position, Mijune. Additionally, I'm curious about what form you keep your cash holdings in. I'm also curious whether you buy short-term bonds in the United States, invest in parking ETFs, or simply hold United States dollars themselves. That was the question you asked. That's quite a few questions. First of all, our investors. It's perfectly natural that among the stocks in your portfolio, there aren't any you want to sell.
Because that's how it is.
If it were easy to sell, it wouldn't have been in your portfolio to begin with. It's the same for you as it is for me. We do a lot of research, think about it a lot, and really wonder, will this stock go up? We think about it 2, 3, even 4 times before finally adding it to our portfolio. After buying a stock with so much difficulty, is it easy to sell it again? It's definitely not easy. So in my case, I regularly rank my stocks. What I mean by this is I line up the 18 stocks I'm investing in according to how confident I am in each one. It might sound a bit childish, but when you line them up like this, usually, for example, Nvidia comes in first, then second, and so on. But let me give you a simple example by creating a hypothetical situation. Let's say you line them up, and for example, Amazon is ranked above Meta. Let's assume that. That's not okay. For me, even though I said earlier that I like Amazon, I actually think Meta is better. So if I'm more confident about Meta, then Meta should be ranked higher and Amazon should be lower. In this way, if you have 10 stocks, then try lining up those 10 stocks in order from the one you prefer the most. And then you compare the portfolios. Am I investing according to the order of preference I have? If the order doesn't match, that's a problem. In this way, it's important to regularly check whether the investment proportions of the companies I own match my personal investment preferences or conviction. The reason you need to check regularly is because some stocks go up and some go down, so you have to keep balancing. And as I always say, stock investing is about relative evaluation. This is what relative evaluation means. You line them up to see which stock looks the best, but you can't just buy the one that looks the best, right? Because our judgment could be wrong, and even if we're wrong, we need to survive. In stock investing, you can't afford to fail, because if you do, your life could fall apart. That's why no matter how confident you are, even if you believe NVIDIA is the best company, you shouldn't only hold NVIDIA. That's what I want to tell you. And I just keep my cash in my stock account. From what I can see, Samsung Securities doesn't seem to pay interest yet. So I also have a stock account in the United Kingdom and I use Robinhood. But with a Robinhood account, if you keep cash, the interest rate is 4%. So I think there's really no need to invest if it's like 3 times higher. I hope more Korean brokerage firms would do the same. People who hold cash usually should get interest, but it seems like Korean brokerage firms are lacking in that area. All right, let's move on to the 8th question. The 8th question is also long. Hello, Miju. I always watch the valuable information you post on pending and your YouTube videos with gratitude. During this downturn, the fear index shot up to 50 and even 99, and it surged in just one day. The fear and greed index fell to a minimum of 4. The S&P 500 fell 4.5% and 5.5% over 2 straight days. Also, among the 500 companies that make up the S&P 500 index, the percentage of stocks trading above the 200-day moving average dropped to 23%. I think the period when all these numbers point to a bottom and everyone feels extreme fear is the optimal time to buy. But if you invest at this time, wouldn't you make a lot of profit in the long run? But Mijune, you didn't buy any of your top picks. Was that because of momentum investing? You asked a question. Was that April 8th? I didn't buy any stocks then. In my opinion, this question was asked at the lowest point. Out of everything I read to you today, I think this is the most important. I've read a similar message at the beginning of a previous broadcast as well. I thought I was all in on United States stocks during this downturn, but there are people who don't think this way. So from my perspective, I thought I was all in, but many Mijune members who watch me think Mijune isn't all in. That's what I'm saying. So I was a bit surprised, and I was also a bit worried. Let me explain what I mean. First, let me give you an overview of the United States stock market situation. This time, the bottom of the downturn was on April 8th. At that time, it dropped to 4.9 times. So as it fell to 4.9 times, the bottom was on April 8th, but the real acceleration of the downward trend started on March 25th. So in conclusion, from March 25th to April 8th, the United States stock market plunged by 14% in just 2 weeks. During that time, stocks kept dropping by 14%. While that was happening, I kept checking the trading status whenever I bought or sold stocks. So how many times did I buy stocks during that period? I bought once on March 26th, again on March 28th, and once more on April 3rd. On April 3rd, the stock price dropped for 2 straight days, leading me to make 3 trades. And after that, I didn't buy any more stocks from April 8th, right? If you're asking why there were no additional trades, I'll answer that for you. At that time, my cash ratio had already dropped below 5%. What that means is I went all in with all my assets on United States stocks. So when people ask me why I didn't buy more stocks at that point, it's a bit of a puzzling question for me. At the beginning of every month, I share my portfolio, and as you know, my target cash ratio is 20%. But if my cash ratio doesn't reach 10%, here's how you should think about it. You can accurately think, oh, this person is being a bit greedy right now. And if I start selling stocks and my cash ratio increases to 20%, you shouldn't think, why is Mijune selling stocks? It's not that he's predicting the United States stock market will fall, but rather that he's just dialing back his greed and maintaining a calm mindset. That's how you should think about it. Everyone watching this live broadcast right now, and myself included, we all have a bit more greed than the average person. We're also people with a lot of guts. I don't know if you all feel the same way, but I think I'm being really greedy. It's the same for you all. You're also people with a lot of guts and a lot of ambition. Because people who don't have guts or ambition usually invest in safe financial products like savings accounts, installment savings, or personal pensions. But we, the Mijune family, are leaving those safe financial products behind and investing in risky stocks. So we need to recognize that the people who make up the Mijune community are those who are taking on a tremendous amount of risk themselves. And it's not like we're even investing in ETFs. Depending on your choices in the market, of course, your performance can vary a bit. But compared to ETFs, investing in individual stocks can lead to completely different results depending on which stocks you pick. Still, we're taking on that risk and investing in individual stocks, even though the outcomes can be so unpredictable. What that means is you and I are really ambitious people with a lot of desire and a strong drive to succeed. That's why we need a safety mechanism that can reduce risk, even just a little bit. That's why I always tell you to increase your cash holdings a bit and to diversify your investments. Because going all in on stocks is just too risky. Since you're investing in such a risky way, I recommend that you keep 20% or 30% of your assets in cash to reduce the risk even a little, and also diversify your investments. So to give you a conclusion to this question, the reason I couldn't buy more when the United States stock market hit bottom on April 8th was because I was already being too greedy and had already gone all in on the United States stock market. So I didn't have any more room to buy additional stocks. I consider it all in when my cash ratio drops below 5%. Having a 5% cash ratio is already considered all in. It doesn't need to be reduced to 1%. I just wanted to let you know that's how I think about it. Next, I'll move on to the 9th question. I still believe in the effectiveness of the momentum strategy, and I want to continue in that direction going forward. However, as my assets approach $1 million, I'm increasingly wondering if the aggressive asset allocation I used in the past is still valid now. As my assets grow, do you think it's right to shift the portfolio structure itself to a more conservative approach? Or do you think it's possible to respond adequately with strategy and momentum investing while maintaining an aggressive composition like now? Now that your assets have grown significantly, I'd like to ask if you, Mentornim, are considering strengthening risk management and taking a more defensive stance to preserve your wealth, or if you still plan to maintain an aggressive allocation and continue with an aggressive momentum strategy. This is also a really good question. Every strategy, not just in investing, but in everything, should change depending on the goal. So the strategy we use will differ based on what our goal is. Up until now, on the Mijune YouTube channel, we've introduced very aggressive investment strategies using the keyword of the fourth industrial revolution. And the reason for that is very clear. The reason we've continued to cover such aggressive strategies on Mijune is because I'm the one running the Mijune channel. But that's because my investment goal is asset growth. I'm not someone with a lot of assets. So my goal was to increase my assets, not just to maintain them. As I mentioned in the very first broadcast of Mijune 5 years ago, my goal is very clear. My goal is to make 3.3 billion won with only United States stock assets. Excluding things like real estate and insurance, I just want to make 3.3 billion won with only United States stocks. The reason I set my goal at 3.3 billion won is because of this. It's because I want to have a cash flow of about 10 million won every month, even after I fully retire. I know that's a bit greedy, but I really like eating out. And when my wife is cooking at home, I honestly don't feel good. I prefer going out to eat. Doing the dishes, preparing and grocery shopping takes time. And I think all of that is just a waste of time. That's why I really like eating out. So when I get older, I hope I can eat out for all 3 meals. That's why I like eating out. And I also like traveling. Even after I retire, I think I'll need about 10 million won a month to keep eating out for all 3 meals and traveling every day. You need about 3.3 billion won because if you get a 4% dividend, that's 100 million won. So that's what I've been thinking in my own way. So I'm likely to continue using a relatively aggressive strategy until I reach that 3.3 billion won goal. But here's the problem. I'm investing mostly in individual stocks, particularly the constantly evolving tag stocks. Investing in tag stocks can boost returns, which is essential to reach my 3.3 billion won goal by capitalizing on fourth industrial revolution opportunities. However, investing in these stocks requires paying extremely close attention. It takes up a lot of time and energy as well. So right now, no matter how little, I spend at least 12 to 15 hours a day on news related to the United States stock market, checking news about companies and analyzing stocks. Basically, I'm spending almost every day completely focused on United States stocks like this. Fortunately, up until now, I've been enjoying this investment journey itself, and I can keep sharing that process through my membership, So it's not just me looking at it alone. If I read 20 articles, there's a gateway where I can share all 20 of them with you. So by living like this without any financial issues, it's a situation I can handle. So physically, it's a bit tough, but I can still manage for now. But I don't have the confidence to keep living like this. That's right. I've mentioned this a few times on broadcasts, but I don't think I'll be able to keep devoting 12 or 15 hours a day to stocks like this in the future. So whether it's in 3 years or 5 years, if my planned United States stock assets grow to 3.3 billion won in the near future, rapid asset growth won't be the goal anymore. At that point, the goal will shift to maintaining the current level of assets. And as I mentioned earlier, strategy needs to change depending on what the goal is. When that happens, the portfolio strategy will be adjusted. So when that time comes, rather than individual stocks, I plan to build my portfolio mainly with ETFs, such as dividend ETFs. After that, I won't need to spend all day reading United States stock news and analyzing individual stocks anymore. The reason I'm spending more than 12 hours a day on United States stocks right now is because I'm all in on tech stocks. And if you want to invest in tech stocks, you need to study that much. Otherwise, you just can't keep up. Every day, things keep changing, and you see new developments every hour. If we don't keep up with this, do we really deserve to be Tesla shareholders or Nvidia shareholders? That's how I see it. So, if you invest in such risky stocks without studying this much, the risks become too great. Because of this fear, I want to explain that I end up clinging to stock news all day long. So, when I eventually reach my goal of 3.3 billion won, probably on the Retire with United States Stocks channel, since it's about retiring with United States stocks, there will be fewer stories about United States stocks. At that time, I think there will be more stories about retirement. Next, let's move on to the 10th and final question for today. I'm curious if you felt anything while experiencing this downturn, such as your strategy during the downturn, or any preparations you made before it happened, or since you've been through several downturns, maybe it didn't have much of an impact on you. Since I'm not such a great veteran investor, it's not true to say that I wasn't affected. Downturns always come quietly, so I didn't really have time to make any special preparations this time either. But it was much easier than in 2022. From my perspective, there seemed to be about 3 reasons why this downturn was easier than the one in 2022. The first reason is that the recovery happened so quickly. Since prices surged back up just as fast as they had dropped, it was easier to recover mentally. The second reason is because of the momentum investment strategy that I wasn't using before. So this time, except for the very best stocks like Nvidia and a few others with outstanding fundamentals, I was able to cut my losses on most growth stocks with declining momentum as their prices dropped. So compared to before, my losses during the downturn were minimized. In the past, when stock prices dropped by nearly 20% like this, among the stocks I owned, there used to be many that dropped by 70% or 80%. But this time, I cut my losses on most of them when they were down by 20% or 30%. The psychological damage was reduced, so I was able to feel some positive effects. And there's one more thing. It's because investors in Korea have become much more mature. Compared to before, all of you who are investing with me now, I could feel that your overall attitude remains very relaxed even during a bear market. Even from the perspective of an individual investor, corrections or downturns are very tough. As you know, I don't invest just a small amount. I have a significant portion of my assets in stocks. So when a correction or downturn comes, it's really difficult for me as well. But from the perspective of an influencer, rather than just as an individual investor, a bear market feels about 2, 3, or even 4 times harder than it does from the investor's point of view. As an investor, if stock prices fall, it's just my own loss, and that's the end of it. But from the influencer's perspective, the financial losses caused by falling stock prices don't just affect me, they impact everyone who is following along with me. It's like I can feel all the mental anguish of every member and subscriber today all at once. I really feel it. I feel like I'm carrying all the burden myself. So this time, even though we're in a bear market, there were hardly any malicious comments blaming me. In fact, even during the downturn, so many people expressed their gratitude for the information and content I provided. There were so many people who thanked me. So I was also able to stay emotionally stable, and it was very easy for me to keep my balance. So through this opportunity, I want to thank all of you who supported me during this downturn, everyone who encouraged me and didn't criticize me, helping me keep my sanity. I believe that most of those at the center of that support were the Mijune All-in-One members. So from now on as well, for my own happy retirement and for the happy retirement of everyone who is with me, I will do my best within my abilities. Looking at the time today, I see that more than an hour has already passed. When I do a live broadcast for about an hour like this, I get completely exhausted. I'm completely drained today as well, but I still think it was a very meaningful time. I can't install a comment section on banding now. I explained this in detail before, but if I add a comment section to banding, it violates the law. I don't have a license for investment advisory. I have a similar investment advisory license, and people without an investment advisory license can't give personal investment advice or similar guidance. That's why it's not allowed to have individual chats like this. The reason chatting is allowed on YouTube is because the content on YouTube is free. But when I set up a paid membership like on banding and provide content, I have no choice but to block the comment section. Because of that, there haven't really been many opportunities for us to communicate with each other until now. By doing this, even if it's just once a month, I can answer your questions. And in a way, we can meet face to face. From my perspective, I can't see you, but it's like we're meeting face to face. Although the main focus is on stocks, I think it's a meaningful opportunity to have a good time together, sometimes talking about life as well. I'm not sure if you were satisfied with today's live broadcast. Compared to last week, there were fewer interruptions, right? So there were fewer technical issues in delivering the broadcast content to you. And also, as I answered your questions more honestly and focused on sharing my personal thoughts like a conversation, it was much easier for me to host the broadcast. So if you like this kind of live broadcast format, I'll try to keep it going next month as well. I sincerely thank the members in Korea who stayed with us late into the night, the members in the United States who are just starting their day, and all the Mijune members around the world. And I really hope you remember that it's thanks to all of you that I can continue my life as a creator and influencer. If the Mijune membership hadn't worked out, I probably would have just gone back to the hotel. The income I get from the Mijune YouTube channel is only about half of what I used to earn as a hotel general manager, including salary and benefits. So if the membership hadn't worked out, the era of Mijune might have ended. But thanks to you, because you joined the paid membership, we can still meet face to face and communicate with each other through the camera like this. I sincerely want to thank all of you. I will continue to improve and do my best to repay you with various information that can help you on your successful investment journey. Let's all keep going strong together until the day we all retire through investing in United States stocks. Have a happy day, thank you.
Subtitles provided by Badal Uiminjuk. Even if darkness comes, I'm not afraid, Mijune. I'll hold your hand and become the light of tomorrow that you can't see. Happy investing, supporting each other's dreams, walking together down a beautiful downhill path. Happy investing, together with Mijune, all of us, until the day we boldly retire all together.
Thank you.